You're listening to Brick by Brick, a work boots approach to your wealth.
Good morning, everybody, and welcome back to another episode of Brick by Brick, a work boots approach to your wealth. We are on episode 8 today, and today we'll be talking about busy versus productive money. And so hopefully we can break down a little bit of what that means. I'm again joined by Connor Theofolt, my good business partner and fellow advisor, and my name again is Kyle Lubeck. And our whole point of doing all of this is to talk about some of the topics that we see other people and some of our clients enacting, and maybe talk through some of the hurdles or pitfalls that they run into to hopefully help some of you all get over those. But welcome again,
Yeah,
Connor.
Kyle, this is fun. We're eighth episode already. Can't believe it. We're rounding out season 1,
Yeah.
which is like mind blowing that we've come this far.
How many we got left?
So we got 3 more, including this one. 10,
Okay.
8, 9, and then 10. We'll kind of put it on a bow, and then we're going to talk about some exciting changes for season 2, if you will. But we're getting rolling. We're finally kind of getting the hang of things, and it's been fun. This is going to be a fun topic for me, especially, I think, because this will speak to a lot of the folks that I think are listening and gleaning things, whether that's someone who does things themselves or somebody who's, maybe working with someone and things like that. But the idea that, hey, I'm doing something, so I must be in control, or I'm doing something, so I must be on the right track. And unfortunately, it's not always that simple. So this will be a fun one. But you got something pretty for us to look at first.
Oh, yes. Yeah, we can't, again, backed by popular demand, a horrible bourbon review.
Good bourbon, horrible
good
review,
bourbon,
good
maybe
bourbon.
not the best
Yeah,
reviewers. So today, Old Elk. It's out of Colorado, I believe, right? Yeah, let's see here. Yep, Colorado. It's a 5-year.
Show that to your camera here, Kyle. Look at the. That is just beautiful, isn't it?
Yeah, it was a pour.
So cool.
It was, I don't know, it's one of them specialty pours
Yeah.
they have. I can't remember if it's around the holidays or something. I got it. And of course, you buy a bourbon, you put it in the drawer, and you forget to use it. And today, I was like, no, we're going to use it today. So
super cool.
Pours right out of there. That's pretty sweet. So yeah, it's a 5-year just bourbon out of Colorado. So let's see how she drinks. So salute.
So before you give your thoughts, disclaimer for my wife's uncle who's watching the episodes and making fun of me for gorilla gripping the glass.
Yeah.
He said I was 3 or 4 fingering it, which made it look like it was super full.
Yeah.
So Mike, I'm holding it all fancy, okay, and it's only like 1 index finger, so we're not getting crazy here. All right.
We're definitely not.
Shout out
we got
Uncle
dad
Mike.
duty later.
Yeah. That's good though. That's real smooth. I like that.
Let me guess, campfire.
Kyle makes fun of me because my only review is, I could drink that by a campfire, which is pretty much everything, not just whiskey. But no, I like that. It's smooth. It's definitely got some spike to it. What do we got here? It's only 88 proof, so maybe that's why it's smooth. It's good though. I just think the bottle is just beautiful.
I don't know how to define things.
We still don't know what notes is.
I want to say fruity, but I don't know.
Still don't know,
accurate.
What tannins are or notes or anything like
That's
that.
wine.
We have put 0 time into getting better at this, so it's going to continue to be a horrible whiskey review of good whiskey.
Oh man,
you should get an overlay of horrible whiskey review.
Or how many times we restart the filming and then we got to refill the glass.
Yeah,
9 times over here.
Yeah, Uncle Mike, it's 1 finger, but we drank 9 of them. So
yes, no, exactly. So
well, it's good though. Go out there and get some Old Elk. Again, just the bottle, prettiest thing ever, sitting up here on the shelf. So.
Yeah, it's kind of fun. So we'll keep plowing through them all, right?
Yeah. Let's take some more. So Kyle, talk to me a little bit, set the stage, if you will, for somebody who is maybe busy with their money. Somebody who goes, oh, I got a handle on it. I do this and this and this and this and this. What that might look like, and then maybe what they're missing. Kind of set us up here.
Yeah, and we see it all the time, and I'm sure everyone watching has come across it in different facets of their life. It doesn't even have to be their money, but someone who wakes up in the morning and doesn't stop until the end of the night, but doesn't seem to be getting really anywhere. I see it a lot with serial entrepreneurs.
Sure.
The ones that are dabbling in 15 different things at the same time, but kind of mastering none of them.
Yeah.
And that translates a lot, that behavior in their business or family dynamics or scheduling or whatever the case may be, but doesn't necessarily move the needle forward. And so what we see a lot at least in the finance space or in the money management space or investing space, is the old adage of the day trader or I heard about this on Instagram. I'm gonna go get in these 10 stocks that a random person I subscribe to said to get into. Well, typically they're getting in after the buy
Mm-hmm.
happened, so now
Mm-hmm.
they're kind of on the after the crest of the wave, and then they're not really experiencing a lot of
Sure.
that exuberance or that gain.
Sure.
So yeah, tell us a little bit about what you've experienced.
Yeah, I mean, it's the investments, like you said. Well, I made this trade, I made that buy. Oh, I went over here and put some money here. I moved some money to this account, then this account.
Yeah.
Even beyond just kind of your classical investment account stuff,
Mm-hmm.
it can be, well, I'm really good with my money, so I put a little bit in the savings over here, and then I get my check in my checking, and I'll pay off this credit card, and then that credit card goes to pay this, and you just shuffle the money around and feel like, look at how great I am at managing everything. And you're basically, the old adage again, robbing Peter to pay Paul. You're both Peter and Paul in this circumstance. It's just a different account. You're moving the stuff around. We see it a lot in different industries too, and different types of investments, right? Sometimes like real estate, for example.
Mm-hmm.
You might get into that rental, and then you pull money out and you flip this house and you exchange that into here. And sometimes that's fantastic. And a lot of people have a lot of success with that. But when it just is kind of like, well, I got to do this, I got to do something to make progress, when that's sort of what's underlying and what's driving it, we can see you get stuck in the mud, and actually you can damage yourself. You can be, not only are you not moving forward, you might be actually moving backwards.
Oh, for sure. Well, yeah, and we talked about in previous episodes some of the psychology that goes behind it.
Yes.
I'm going to hang on to this sinking ship just because I'm going to make it work. And sometimes the math just says don't.
Yeah.
Right.
Right.
Or this is the hot sector, or ran into it, quantum stocks. End of the year, coming in the beginning of the year. I mean, some of the greatest losses I've seen where people are adamant, nope, this is going to be the next thing.
Yep.
Well, it may be.
Right.
But there's a timing component. There's some research that should go into it, all those kind of things. Or like you said, the flipping of the houses. Fantastic. You guys and gals have made a ton of money doing it. But if you're doing it as a hobby, or maybe you don't quite have the crew or the knowledge or the connections, or understand what is valuable upgrades and what is not, there's some learning curves there.
Totally.
You got to be okay with the first couple maybe not being as profitable, but also valuing your time. Right.
Right.
You go and spend 8 months flipping a house, you clear 30-40 grand, feels good in the moment. But if you match that up, I did one client who flipped a house, and doing an hourly work at $30 an hour, they could have made more working at Subway.
Yeah.
And so that's an unfortunate trade-off there, but they feel very accomplished, which is great. There's something to be said about that growth piece. But if the goal is to grow the net worth, if the goal is to be efficiently productive, you got to be real cautious you don't fall in that trap.
Yeah. Well, and you mentioned the psychology, Kyle. If anyone goes back and watches our behavioral finance, or kind of the real risk to investors, which tends to be their behavior, right?
Yeah.
One of the sort of financial fallacies or emotional mental things that we as humans tend to fall into, and it's everybody to some degree, is something called the illusion of control. And you kind of touched on that. I'm doing something. I'm trading in my account. I'm pushing money from this investment over to this money market, or I'm holding this and I'm doing this. And if there's a strategy, if there's a reason to it, that's great. Yeah. Those are good things. Stay consistent, create the structure, which is really what we're going to talk about, which is surprising no one that's listened to our episodes. But that illusion of control. Well, I made a change, which means I'm in control, which means what's going to happen is going to be positive because I did something. Yeah. And unfortunately, or fortunately, I guess, depending on how you look at it, just because we're putting in sweat equity, sweat hours, does not mean we're going to have positive outcomes. You can look at that one of two ways. It's futile. It doesn't matter how hard I work. It's not going to necessarily, make something happen. Or, hey, that's not the thing we should focus on. Yep. Don't focus on busting your butt on managing your account in, kind of sporadic ways because you think you're in control. There's other things we can be focusing on as part of that structure, that long-term plan, that are going to more likely lead to success long-term for that person.
Yeah. But I like that, the illusion of control.
Yeah.
The busyness doesn't equal control. That's a good one.
Yeah. Often I would say too, Kyle, when we're managing money for clients sometimes, and obviously that's an experience not everyone listening has, but managing your own money too, we may have this plan, right? That's what we'll be talking about a lot, is planning. We're setting up the structure for the long term to accomplish all these different goals. We might set something up 6 months later, client comes back and goes, oh, well, I went and I bought this thing. Yeah. This is what I saw on Yahoo Finance, or my buddy said this, or I saw it on Twitter, or whatever it is. And you kind of break that long-term plan, or you sacrifice some of it for something that might work out. It's not always wrong, certainly, but something that was kind of out of left field, wasn't part of the structure, didn't go through sort of the rigorous process that it should to win a piece of your overall plan.
Well, and it's not built to any future goal.
Right.
We see it again. I'm going back to social media because it is notorious for getting people excited short-term on things. But, turn yourself into your own bank, set up this trust, you never have to pay taxes again, on and on and on. There's all these different
Yeah.
taglines, which in and of themselves may be true. But I've worked with some of those trusts. They take months, if not years,
Right.
to set up. They take expense to
Mhm.
set up, right? They take consistency and administrative work to set up, or turn yourself in your own bank. It's a life insurance
Yeah.
strategy. Fantastic for those that do it. But guess what? After you get it and set it up, guess what it becomes? Boring.
It does.
You got to keep
Well,
funding it. You got to
absolutely.
make sure you abide by the laws and the metrics that maintain that. So
Yeah.
if you do it correctly, it works fantastic.
Yep.
But it's not right for everybody.
Right.
And so I've seen it time and time again where people get excited, they want to do this, they like the outcome,
Yep.
the forecasted outcome, but they don't understand it might be an 8, 9, 10 year
Totally.
fund to get there.
We want it quick. We want it snappy.
Quick.
Even and beyond the investment accounts, kind of like you're getting at, back to sort of the cash flow management, right?
Yeah.
A couple of times I've seen people who, oh no, I got a good handle on my cash flow.
Yeah.
Okay, cool. Tell me about it. Well, I get money, comes into this account. I then move it into that savings account because if I put it there for 6 months, I get a kicker.
Yeah.
And then I pay off that card, and that card's waiting a little bit, but I got a 0% financing. And what happens is,
and then I'll transfer it to this card
transfer
for
it over
points
here
so that I
for
can
points.
go on a trip
So they've
that
got
costs me
this
10
like
grand in cash.
yeah, they've got this complicated thing. They've got 6 bank accounts that all kind of do the same thing for
Yeah.
different reasons. Oh, I forgot to close that one once the kicker went away, the
Yep.
teaser rate. And then if you dig into their 12 months of cash flow, they're actually going backwards. They just couldn't tell because they were so busy and things were going so far, so all over. Little bonus here, a little extra spending there, oh, a little this. And you actually cover up that you're going backwards. You don't even realize. And fully good intention.
Oh, of course.
Just focusing on the wrong thing.
Yeah. It's and then checking the accounts every day and
Yes,
checking your
over-monitoring.
investment accounts. Oh,
Absolutely.
It's good to be on point, but I would say if you're going to monitor your accounts every day, have a reason.
Yes.
Not just stressing yourself out.
Yep.
Oh my gosh, the market went up 0.02 today.
Yeah.
Great.
Yeah.
Oh, the next day it's down, 0.08.
Yep.
Oh, I don't like seeing red. I got to call, or I got to trade something,
Yep.
and it becomes every morning. You hate going to your computer, but you build a habit that you can't undo.
Right.
And people get so stressed and so concerned, and really it's a system,
Yeah.
right? And if you have a fundamental belief that over time the market will continue to grow up and to the right, use the analogy of yo-yo on an escalator, which I just think is fantastic.
It
A
is.
good friend of ours, Dan, one of our advisor partners, said that, and it was fantastic because if you have a fundamental belief that it'll do it, and you are willing to take the risk to deposit your $100 into the market, it is going to go. You want a healthy market to go up and down over time, but over time, up and hopefully to the right.
Yeah.
And then try and mirror those goals at whatever arbitrary time you set in the future back into, okay, this is what needs to happen, and this is the amount of risk I'm willing to take or I need to take to accomplish those goals in those time frames.
Yeah.
So again, everything goes back to a plan, and it's not just about chasing returns or the sector that's hot, or just, I always ask people when they're putting, investing, what is your intention with this?
Yeah.
Well, to grow the account. To what?
Yep.
$1 billion, $1 million, 100,000.
Yeah.
It's different for every person. And if you step back and segment that pocket, that pile of money that you're building in whatever way you're doing it, real estate, the market, whatever, if you can pie it out and say this amounts for this goal, this amounts for this goal in these time frames, that's where you start to really make some impactful, because then you're not taking unnecessary risk.
Totally. Yeah, I mean, Kyle, I think about, we're both on the investment board of our firm. We all have our clients and we manage money for people. And every single week, a number of us get together and we talk about the investments. We talk about what we might want to buy, what we might want to sell. We talk about the macro incidents and things going on and things that might fundamentally change. And that's part of our structure and our strategy. And I mean, hand up, look, just because we do this for a living doesn't mean there aren't times where we're looking at the red numbers and going, oh man, do we need to make a change, right? We're this war in Iran is happening. Markets are selling off 10%, tariff wars. These things happen. We're not immune to it because we do it every day. The point, though, is we fall back on very specific structures, each other, but also thresholds and goals and sort of targets we're setting, upside, downside, before the emotions start coming. Yeah. Look, we manage other people's money. And honestly, a lot of times, again, full disclosure, I feel more responsible for other people's money than I do for my own.
Oh God, yeah.
You know, I'm more worried if
So
seeing
there's
red
been nights
numbers
where
on
I've
other
been
people's
just sick
accounts.
worried about it. 'Cause it's
Absolutely.
like
I mean, we're up in the middle of the
people
night.
work
We're
their
up
butts
early.
off
Yeah,
all year,
of course.
and then they trust some tall and short ding dong, you know, to
I'm slightly above average height.
average
Slightly above average height.
light bulb changer.
Yeah,
right here.
like
That's,
no ladder needed. But the point being, don't feel bad if you have those feelings.
Yep.
Again, we talk a lot about have a confidant, have a friend that also does it, have an advisor, even if you're not working with them, that's willing to just say, hey, take a breath. It's going to be okay. We consume a lot of the same news other people do. We see the headlines. They're trying to evoke emotion, all that kind of stuff. You
trying
got
to sell something,
and this is
or
why
unsell
the
something.
only chance you have as an
Yeah.
investor, as a person trying to do well financially, is to create the habits, create the structure, have your focus be on the long term. You said the yo-yo on the elevator, right? So it's going up like this, but in the meantime, it's going like this.
Escalator. Elevator would be awesome.
Elevator would be straight up.
That'd be really great.
Yeah, that'd be
that.
sweet. No,
but
escalator. Excuse me. Yo-yo on an escalator. You know, it's going up and to the right. It's growing. Companies are doing better, more profitable. People
Yeah.
go to work every day and work hard. That's why the market goes up and to the right, right, over time. That yo-yo is the part that can get emotional if you're over monitoring, if you're constantly making little tweaks and changes, if you're not focusing on the long-term strategy you set up because the new hot things going on or the new scary things going on. So long-term focus, like Kyle said, bucket that money. Kind of the viewer question we got was right in line with sort of the aha of the conversation. It's like, well, what's the difference between engaged and structured? Or how do I know if I'm being prudent and I'm not just setting it and forgetting it and not being responsible, but balance that against doing too much? So basically, how often should someone be looking at investments, or how often should they be moving money around cash flow wise? How much busy? When does it go from busy to productive? I guess.
Yeah, and that's a great question. You know, as always, anything in our industry, attorneys, it depends, right? Every person's different, but you know, if it's something that you're not actively engaged in consistently, go in once a quarter, make sure your 401k is balanced, you know, rebalanced. You know, if it's something that you have an end of the month with your spouse, and you go in and you look at stuff and say, is this, you know, still pursuing our goals? Or situationally, right? War in Iran starts. Great time to go in and reallocate, right? Maybe you know, don't invest in an any type of airplane company that flies in Iran. You know, right. But maybe do a move on oil,
sure,
because that became more volatile. You know, so there is situational investing you can do when things pop up. But you know, a word of caution as you start to look for those: peel the onion. A lot of people take the first news story, or they see it on CNN and then MSNBC, Yahoo Finance. They see all these headlines. They don't understand that they're all kind of in cahoots with each other.
Sure, yeah.
And so peel the onion. Go in and do additional research, dig on some of the points in the story and say, okay, how is this actually working out? Or what is this impacting? Maybe don't go for the mainstream company that's being touted. Find the supporting companies under the hood that are integral to that company's success. And if that company isn't the company, any other companies working in that sector still need that secondary servicing company, right? You know, peel that onion, which really becomes important. And a lot of people just stop at the exciting one, go and do some sort of investment choice, and now they feel they can talk about it with their friends.
That's a great point, because you know, people have asked us, you know, in this conversation about being long-term, listening, well, you don't make any changes? Well, no, we don't. We make changes, and even during the Iran thing, some changes in the portfolios that were prudent and they worked out well. But it's full of structure. There's analysis that happens, and then another level and another level. By the time we're getting to actual decision time, buy, sell, whatever it is, the emotion's pretty much gone. We're now dealing in fact, and it's not perfect. It doesn't always work out, but we're also not making bets that are everything, right? I've got friends that have asked me questions through the podcast and otherwise. They're like, well, I've got a little bit here. I'm thinking about moving it all over to here. And it's like, man, I can't even really help you with that, because you might be right, but you might be really wrong. And I don't deal in those absolutes, because that's not the prudent thing. That's not the long-term strategy. Like you said, here's your bucket for if things get goofy in this way, that's what we're going to put in cash, or that's what we're going to move to this, or and let the other stuff kind of cook, if you will. It's just, you got
Bitcoin's down 50%. Should I sell my 401k and buy all Bitcoin?
Yeah, it's like
probably not.
Probably not. You know, it depends. No, but probably not. You know, because all or nothing tends to be not a place that most people need to be. Again, at the end of the day, the average investor, across so many studies and thousands of pieces of data, doesn't do well versus the market overall, because of the emotions. To the tune of 3, 4, 5, 6% a year over your entire lifetime. You're going to lose if all you're doing is watching and reacting and tweak and big move and jump to this and chase that. Those are the
and you
things
can
that we want to
convince
iron
yourself
out.
of your answer.
Absolutely.
Our
Confirmation
brains
bias is
are
huge.
massively
Totally.
important and massively strong
Yeah.
in the sense of we can convince ourselves of pretty much anything.
Yeah.
And that's why I love our investment board. Because the five of us, we don't agree all the time.
And that's the point.
And sometimes we get after each other a little bit, which is
Yep.
great. But having differentiation in the viewpoints we take towards one decision, multiply that over an entire portfolio. That's where you may not win. I may not win, whatever, on my suggestion. But then at the end, if there's a consensus, now you're taking emotion out and you have
exactly
5 different eyes on the same decision.
Yeah.
Not everyone watching has that
right
point. So again, in a previous episode, find that captain in your life. Find a confidant, whoever, to bounce your ideas on. If you are really entrenched in an idea and you say, hey, I'm thinking of it this way, I want you to look at it from the opposite and help me see what I'm not seeing. If you're going to make a big move in your portfolio, buy a property, invest in a business, start a business, do whatever, get some outside perspective and say, all right, poke holes in it.
Yeah.
Right.
One of the best real estate investors I know, flipped a lot of houses, had a lot of success in development and things. Really, really awesome guy, smart guy, successful. He said his number one litmus test for any deal is I'm going to find out why I shouldn't do this deal. And when he failed to find a reason not to, pretty obvious that that's a deal to do. And
there you go.
It served him well. And again, there's a lot to that. But so overall, I think the takeaways are we want to be productive, but not busy. We want to be engaged, but we want to do that in a structured way. We don't want to over monitor. We don't want to over change. We don't want to over tweak and get caught up in that stuff. Keep yourself focused on that long term.
Yeah. Or over log in. If it's stressing you out, shut the laptop.
Anytime you feel some bubbling, you feel some heat in your face, you feel a little bit nervous, you're not sleeping, you're distracted from day to day because of one of these things, cash flow, investments, anything like that. Stress happens when you're being productive. Maybe it's time to take a step back and go, you know what? I'm only going to let myself look at that every week once, or every month once, or every quarter once.
And create a system around that.
Yes. Yeah. Again, it's the idea is create the structure, create the habits before the emotions introduced. And let those structures and habits carry you through those emotional times.
Yeah. I feel like we get so philosophical sometimes on this stuff, but so many, almost every bad choice I can think of that either I've made, a client's made, friends have made, whatever, it was emotionally based.
Totally.
And so introducing that into habits that have been established for 20, 30, 40, 50 years, people watching this or people who are trying to change that behavior, it's tough. And so I get it. It's tough. I struggle with that sometimes too. I got a wonderful, spouse who helps me navigate through some of that. And vice versa. It's if you can just calm in the storm, man, I mean, the decision making becomes easier once you build those systems and processes.
Totally.
So yeah, sorry, could go on all day on this stuff because it's I just see it all the time, especially in certain industries, just constantly moving money here and there. It just doesn't go anywhere.
Yeah, absolutely.
So very nice. Okay. Well, anything else you want to add to this?
No, I think that was pretty good. You want to ride us into episode 9 here?
Yeah, let's see here. Episode 9. We are so episode 9, please join us. It's why simple plans win. So we'll be talking about, the KISS model. Keep it simple, stupid.
Simple, stupid.
Build the foundation, build off of that foundation, and then you can become complex. Don't just jump right into the deep end right off the bat. So again, why simple plans win. Please join us again. And if any viewers have any questions or concerns or want to make fun of my lack of boots today, please email us at workbootswealth@gmail.com.
Bully him, internet. Bully him. I'm also not in boots. I came from the office.
It's Minnesota and it's like 110 degrees and
so
120% humidity. You're lucky I have a shirt on.
You can make fun of the fact that you can see his knees, but yes, it is super hot, and I'm probably going to throw shorts on in a couple of minutes anyway. So,
thank you all for joining us. Thank you, Connor, for the conversation. Hopefully this has continued to be helpful for those that have stuck with us and subscribed. Please hit that like button. Please hit that subscribe button. It only helps us out as we continue this hopefully helpful process. So cheers to everyone.
Cheers,
buddy.